when my founders call and say they're buying that beachfront property that is like, $5 million, it's amazing. The kind of founders I back are immigrants. Going from there to then having their bank account changed after like years of struggle, those moments are amazing.
Welcome to Money Moves, the show about raising money, making great investments, and building venture scale businesses. I'm Neil Devani, your host and the founder of Necessary Ventures, a firm investing in what the world needs. Each week, we'll talk to folks who have raised anywhere from $10 million up to billions of dollars. We'll learn how they return multiples of 10x to 100x or more to their investors. We dive into their stories, uncovering what worked and what didn't, learning from real experiences to understand the journeys of raising capital and rapidly scaling a business. Money Moves isn't just for those already in the game. It's also for anyone interested in the mechanics of startups and venture capital. Whether you want to raise money, make better investments, or just understand how it all works, Money Moves gives you the insights and advice you need to succeed. So join us each week and hear from those who've been through it all and learn from their journeys. Shruti, thank you so much for joining me for an episode of Money Moves.
I'm so excited to be here.
I love to start by just asking folks about their background, how they grew up, how they got into tech and venture. So can you take us back to baby Shruti?
I mean, how far back? But I'll make it fast. I grew up in India and I moved to America in 99. I was on the East Coast, New York, and spent, a decade on the East Coast. I would say that really framed me and made me hardy and more well-rounded and more of a straight shooter. Then I made some quick stops in Boston, Chicago, and then Bay Area for 12 years now. I think Bay Area is the best place I've ever lived. And I think it's definitely more my personality. And so I think that's the background. But then in terms of career, I think I switched into wanting to be all sorts of careers in the early days to just engineering. Studied computer science undergrad, started working and had 10 years of an engineering career where I built early data AI systems, then started a company also in the early data system world, and then got into venture 12 years ago, which is why I came to the Bay Area.
Tell me a bit about making the transition from being an engineer to being a founder. You had a career successfully, long tenure at IBM. You were doing interesting work there. And at some point you said, hey, I got to go do my own thing.
Actually, that was a funny thing. It was always in the making for me, but as an immigrant, I needed enough money to take that risk. So every step and every move I made was always around, this is going to help me with my ultimate goal of starting a company. So within IBM, I worked on some amazing things. I was there a decade, but I worked on 5 big things and they were always additive to how I thought the skills I needed to start a company. I think so. The goal was to always, I come from an entrepreneurial family. I wanted to start a company. My dad is an entrepreneur. I was always eager to help him out. The thing is though, starting a company is a very different beast, especially in a different country, especially venture-backed companies, which I had no business understanding. I had no clue what it meant to start a high growth venture-backed company. So I paid for that in the wrong ways where I couldn't raise the right amount of money. I was building it in Chicago, which is now a different market, but 14 years ago was a different market. So I think it's been a growth, but that transition was many years in making. My co-founder was my classmate from Columbia, where I went to master's in computer science. The business was what we had built there and like an offshoot of that. All of this sounds really great in a Silicon Valley style story if I actually just knew the fundamentals of business making. What I tell people now is that is just a project, not a company. And most of us are stuck building projects, not building companies, especially without serious, solid customers.
What's the distinction in that
Customers.
you didn't have as much front loading of spending time with customers and understanding what they were looking for, what they wanted?
No, I would say in my case, it was more lack of definition of customers. The product I was building would be more applicable to an enterprise. I didn't know anything about enterprise motion. And then I was going after a consumer company and I've never built one. And the making of a consumer company is very different. And the makeup of a founding team is very different. So actually, look, I think I can speak about all this right now. But when I did fail, the reason I got into venture was to purely understand venture-backed journey, founders who could go build companies, fast, raise money fast, accelerate fast, all of that. So I spent a lot of time learning about that. And then the venture experience was purely to add to that like kind of reverse engineering of starting a company.
Eventually you would start another company or
Yeah, the goal was to always go start another company.
and what happened? You fell in love with venture capital?
Actually, no. I was going to go start a company after 2 venture stints at Samsung Ventures, Samsung Next, and then True Ventures. And then I was going to go from there to start a company. I was too good as a VC in the early days, meaning I had exits by that point within a few years. So the founders I'd backed had been acquired by Apple, McGraw-Hill, Samsung, and one of them just got acquired for $500 million 10 years in. So I feel like those founders and the ones I couldn't back, there were many others who were also acquired that I couldn't get through, but they saw how hard I worked for them. So anyway, long story short, these founders told me if I was raising a fund that they would invest. I had no business understanding the venture business starting. I mean, it's one thing to be a VC, it's another thing to start a VC firm, especially in the era when the world was not set up for that, especially not for solo GPs, not for back office for a firm like me. AngelList wasn't even that popular. They were just early. SPVs were so expensive to do. So I think this was the accidental VC solution that I ended up with, which was people wanted to invest in companies that I was finding for them. It was expensive to do SPVs. We pulled the money and it became a fund. That was fund one.
How big was fund one?
We ended up doing about 9 million across a few things. And yeah, we returned fund one last year and we're about to return another chunk. So it will be about 4.5x.
What was the process like just in terms of like, how long did it take? How many pitches to raise fund one? It sounded like the impetus came from people saying, hey, you should do this. So maybe it was a little bit easier, but still fund ones are hard.
I mean, also check sizes are not going to be like what makes the whole fun, right? Like the thing about, I tell my founders, it's not that I want to compete with how hard it is for them. It's very hard for them, but they need maybe like one large check and then a few small checks in an ideal scenario. If you were doing a party round, which is not a popular party round, that's a very hard situation to be in. That's what venture fund is. Nobody wants to be more than 10% of your fund. And so it ends up being LPs are all in it, but no one LP can be your anchor LP. I mean, it can work. That can work in the early days, but that was usually not the case for most people. So you have to go hunt. So after your initial set of folks that, that believe in you and take a leap, nobody can still write millions. So then from there on, you go start figuring out, what do I do? Like, well, now that I've started this thing I didn't know anything about, I'm on it. You talk to a lot of people, you kiss a lot of frogs. You have no clue what fundraising looks like. Signals are mixed and hazy. Anyway, all those things happen. So how many meetings did I take? I don't know, hundreds. I don't have a track record on how many I took. It was definitely a lot. And it took, after the initial set of folks, it took, I would say, another year.
Did you find it different when you raised fund two?
No. What happened was, at that time, solo GPs were not a thing. That was not even a term. Even then, people that have spun out to be solo GPs are pretty popular folks. I just landed in Silicon Valley not long before that. I came in first time ever in 2009, loved it, wanted to move here forever. But then I realistically moved here 2011 summer for an internship between my first year and second year of business school. Got the network. I lived in one of the Stanford houses, really understood. Like, I didn't even go to Stanford, but I really gained that network and learned the makings of the personality, people, network. So that summer was really transformational. And I worked at a venture fund here, and that's why I'd moved here for that summer. And then 2012 was my first real full-time move to the Bay Area. And I think my fund started basically in 2015, 2016. So that's not enough time in Silicon Valley years where people know each other from their early Coupa days and early Palo Alto Network days and early whatever, Webvan days, whatever it might be. The thing that makes Silicon Valley is like people know each other. There's credibility. And even if you fail, they want to back you. I had none of that. I knew one person when I came here, someone I'd worked with at IBM, or at least, and then crashed on their couch. That was in 2009. And then did that again in 2011, 2012, basically and then really built out my network. So the fact that I was also on these boards and getting these exits early on was also pretty new, but I didn't have that much of a working relationship with a lot of Silicon Valley people. So I would say that Fund 2 was also hard because it still came in 2019, not that far from then. And the track record for 2016 was not that baked out yet. And enterprise companies have a real J-curve. And I'll tell you that now. And the J-curve is very deep. So I would say it takes 4 or 5 years for an enterprise company to truly get somewhere. And if you're a 2016 fund and if you're investing over the years for 3 years, for our funds are every 3 years, after that, you don't go from there to, like our companies are not that mature yet by the time you raise a second fund. So it was not easy, but it was not hard as fund one.
Yeah, you had evidence for what you were saying, but it was still early in terms of results as far as like the company markups, revenue, things like that.
Yeah. So we ended up raising about 30 million between a few entities and stuff. So that was great. And I think that kind of really gave me a lot of leverage. And then fund three we raised in 22 was about 76 between two funds. So that's that. And we're starting the fundraise for fund four, which is going to be the same size as 75.
Yeah. Awesome. As you went into the Fund 3 process, you got some institutional LPs in Fund 2, Fund 3, I imagine, more. What did you learn about the difference in terms of those processes with institutionals versus with founders, for example, that you had backed previously?
Early days, you want to surround yourself with cheerleaders. And I think that while I think sometimes it feels hard to fundraise, Fund one and two really gave me the freedom to just experiment. I thrive well in situations where I may not be able to articulate most things, but people take a leap of faith. I mean, that's a big, tall order, though. Like someone who just landed in Silicon Valley had no networks, and now I'm asking people to do that. But people did. And that's the thing. I look back and I go like, who are these amazing people who just like believed in me? These are like really good people who believe in
They call them angels for a reason, right?
yeah, they are, right? Like kingmakers for a reason. And that's, I think, our job. But yeah, so I think for the first two funds, I had like a lot of freedom and liberty. It can go both ways. Like there are people who also then have fraudulent behavior and stuff around it, as we all know. But I, on the other hand, was doing it all like as scrappy as I could. I remember meeting one of my big investors a year after. I was like, I haven't taken a salary. I just want you to know that. And it's like such a startup mindset. And someone like him would like know a lot about funds and stuff. And he's like, well, you should do that. It's regardless, it's yours. It's called management fees. And I think I run into managers like that still. And I tell them that, I give them that advice back. Like, you'll just have to, like it's just inbuilt a certain way where funds, you probably still have to pay taxes on that anyway. So just take it. But that's the thing. You have to hustle and you have to figure out things fast. And those two funds were more of that for me. Third fund, yes, we actually did it different. Again, our fund one and two the LPs have been so amazing. They all came back for fund three. And we closed most of, like, I would say half of our fund with those individuals. And then we went to institutionals and we said, we're looking for a few more. So we added like 5 institutions. So I've done it all reverse with a lot of hard work. I would say a lot of people go out of the gate today and go after institutionals with a good team. It certainly makes your life easier. But I would say that then you're constrained to a playbook because institutional investors back you for your strategy. They back you for the kind of access you think you've had in the past. They back you for a certain playbook that is missing in their portfolio. I don't know, whatever it is, but it's tough for them to then switch it up. And if you do go do that midway, it's like a lot of explanation. For me, I experimented a lot, different types of deals. I would call it enterprise deep tech. And my fund one has some really differentiated, but really big companies like Solugen, which we would have never invested in if we had institutional investors coming in and scrutinizing our portfolio as to like, well, you don't even know this category that well, but that's like a multi-billion-dollar company right now. So we've had a bunch of that experiments that have worked out well, that I think without the scrutiny from the institutional investor has given us a lot of, a high, leeway. And actually fund one is going to be a top decile fund, if not even better, in terms of a lot of metrics right now.
How do you think about that going forward in terms of being able to maintain flexibility? It does seem like, there are larger institutional funds who have much broader mandate, but then there are smaller institutional funds that are very, very prescribed, right? And it seems there's a lot of range. When you think about fund 4, 5, 6, how do you think about that?
When fund 3 happened, and I was very lucky, all my LPs are incredible, but I didn't know them. I didn't know most of them for that long. You also have to think about that and do the diligence on people. And it's not that they're good or bad people. It's just that your style has to match their style. Some people are really buttoned up. They like that kind of oversight. they're more articulate than me. I think that's just a personality thing. And I think for us moving forward, yeah, we want to make sure we partner with the best LPs, and we're fortunate to have them already with us. So as we think about adding about net new, 3, 4 new investors, we're thinking through, well, what kind of things we're adding to, we're looking to add that's missing in our current set of LP base.
Let's talk about some of the investments and some of the companies. Can you talk about some of the best investments you've made and how you found them, what gave you conviction early on?
Yeah, one of my best investments right now is a company called Placer AI. Found them through our angel network that I'd created since day one. That's more like an operator angel expert network. It's all mixed, 500 people in there. And it was also coincidentally my master's thesis, location-based services. I have a bunch of patents in the space. When I met them, it was a solid team. I'd underappreciated how much of a good team it was at that time. Obviously, I had inklings, but like they had sold a company to Salesforce Israel before, so they were not that known here. But it was like a 4+ founders, but 2 of them were father son. That was like the best, I would say, setup. And the CEO is a son, not even the father. And the CEO came from IDF, had worked on this location-based services insights for IDF, had really high pedigree in Israel. And then the father could sell you anything you need. Kobe, so CEOs know him, and then Kobe was like a sales head, and Noam was CEO / CTO. And there are 2 other founders who are also CTOs and other technical people. So the foot traffic insight is what they kind of solved for. And I had spent a lot of time in that category. And it's a category that a lot of Silicon Valley VCs did not want to touch. Privacy is one of the big reasons around that. I had, funnily enough, like worked on so much location-based services by that point that my motto that from like I'd read somewhere like in 2009 was like, privacy is dead. And I was like all on board with that. But frankly speaking, also there was the approach they were taking was definitely not leading to privacy is dead. It was just a little bit more risky for some VCs who are used to seeing like a little bit tried and true of a company that's based. At that same time, there were some popular companies like Foursquare doing different things. So VCs were kind of like burnt out in that category, and there were a ton of dead bodies. Many people were using this location insight into ad generation. We did not want that. So everything they were doing was very different and exactly in the thesis of what I would want to start or invest in. We ended up investing them. Every single round after that was very difficult to start. to raise money for them, because VCs would still not get over the fact, and J curve is real. And coming out of the J curve, even if you have some traction, most people pass on the company. Largest firms were very close to investing, but then Apple will release some like privacy statement and it would spook people. Anyway, so we doubled down every round, and now we own a ton of that company. And that company in January announced they were over 100 million ARR. That was last January. They've grown 2x every year for the last 4 years. They closed their 1.5 billion valuation round over the summer last year, and we invested at 8 post. So for us, we've gotten a lot of our friends into that deal. And I think at that time when I was starting out, I was not a strong signal to a lot of people, but now I am. But at that time, it was like a lot of begging to like, I know this doesn't make sense, but you should invest. And I think a lot of people have been grateful. So that was a good story on like believing in myself even. And we've had a few of these stories. Crowded market, others don't believe in it. We see something different, we double down. And I really think that is our playbook.
You also have really built a brand around pre-seed and being a first check-in, investing in that first round, investing before there's a product. How do you think about doing that with a company like Placer or any of the others where you're looking at something that doesn't even exist yet?
Yeah. So I think for us, it's I joke that I have the technical background, so I'm not phoning a friend for diligence. So usually before I take the meeting, I have a thesis on what I want to do. And then once I do meet with the company, it's very easy for me to like just go under the hood and almost kind of relate on a very technical different level without phoning a friend. And I think we decide within that first meeting if we want to invest or not. Ideally, what we found is founders cannot take that kind of a rapid response. They want to slow down. They're not ready for it, but we are ready. And so some of our popular companies have all been taken. I think like smartest people go in with wanting to make a decision. And I think are willing to accept this kind of a decision. So some of our popular companies, their founders are also ready to go with that mindset. And they're like, okay, you're in, I'm in, I see something. This is not rational, but let's do it. And I think those kinds of like, I know that you should be spending energy on certain decisions, but not on a decision on like, if an investor is not taking your board seat, like you don't have to overthink it. But a lot of people do, and they want to add and stop because sometimes their gut tells them otherwise. Yeah, or maybe I should say no. Sometimes their mind says otherwise, but gut says something else. But they don't listen to their gut. So for us, back to the how do we decide? We're looking for a lot of simple things like do the founders know their category? Have they built this before? Are they technical? And then all the other things like surprising them with a term sheet or a commitment, and how they act from there actually has been a very interesting way to see where this team is going to take this company.
Can you expand on that more? Like, let's say post offer, the range of responses and what that tells you.
I think most founders are shopping. I think most founders are told that they should not accept the first few offers. Most founders think of this as like end all be all. Some people even like incorrectly think this is a 10-year relationship. And so it's true and false at the same time. You're going to have a lot more other experienced VCs on your cap table. You're going to forget about the first investor. So unless you really want to remember them, which great founders do. But like, again, there's very rare in our portfolio where you feel like the founders are like, I'm so upset I took their money. It's like that really rarely happens unless you just have no idea what you're doing. So I think if you come in prepared with knowing that this is how this firm can act, do your homework, be ready to have a response. Even a simple response as like, look, I really like that this is the 3 doubts I have about it. What do we do about it, right? That collaborative communication can go a long way and can really show a founder's ability to sell, make complex business decisions, sell to enterprises. And that's a true test for us.
What does it look like to fail the test? Someone who just has no idea how to respond to the offer or the interest?
It's a natural fizzle out, which is okay. I think most of them hide. They don't know how to respond to your messages after that. And that's okay. For us, it's like crisis averted. We don't want those founders to begin with. They don't know how to follow through. They just like have anxiety. I had a founder once who like, I couldn't sleep all night. It's a simple decision. You can just say no. Or you can say, here's why I feel like I couldn't sleep all night, and here's what I want to solve for. But to like lose your sleep over it or anxiety, it's fine. Like, I think you can grow. I think it's just one of those things that you've never encountered before. You like also can get stressed around this. But if there is like I think for what we look for is like that seasoned decision maker. It could be a young kid. I'm not even talking about, it's not an age thing. It's someone who just shows up wanting to do a deal.
They know how to think about it correctly.
They do. Yeah.
I appreciate the story on Placer. We can leave out the names, but can you tell us about some of the worst investments or like companies that didn't work out and what you learned from those?
It's not worse as much as a learning curve for me. The biggest learning curve is not having clarity on people and their vision. I think if they're not able to articulate what they do and you think they're smarter than you, but then you like kind of take a leap of faith and you're like, sure, I'll just go for it anyway. As an investment, you failed your own test. Which is like, if they're not able to articulate how are you going to be able to sell them to your peer group? Second, many founders end up like dreaming as far as a Series A. They've not gotten that far, and big to them is that. And then I think when they do raise that A, they like lose track of their North Star. Because if like an Andreessen or someone invests, if any big firm invests, they think like now they're supposed to take direction from that investor versus like have their own opinions.
Ground truth from the market, from customer.
And I think the investors are like, I invested in you because I thought you were smart. You should tell me what to do, right? Like it's like and then you can lose balance really fast. Like I've seen this go south so many times, just like first board meeting is horrible. Because now the first board meeting is like 3 months or something. And the investor now is expecting still a trajectory. But if you invest in a company and then you didn't meet that quota of like what your target was last quarter, which you said to the VC that was going to happen, and now the round closes, you miss that quota, you're not communicating well, it's pretty common. And it's not that uncommon to just go head front and say, look, we were fundraising, but here's a plan. And here's what we are going to get to now that we have the money. And we're not going to repeat that missing of the milestones and, all that. That's taking it on as like ownership of like, it was distracted. Now we have the resources, right? Like that's what like a good VC is looking for and a good founder is doing. expectation management and managing up. But that's where I feel like things go wrong. It's not worse investment management. It's back to a maturity of communication and being able to just deliver good and bad news to people.
You've talked about like quality of decision making and like good decision makers, complex business decisions. How do you think about what makes for good decision makers versus bad decision makers?
I think good decision makers know what they know and know how long it will take for them to get more data. And is that long enough time worth it? Sometimes you just have to act on something. I think crisis management, background in crisis management, or, even like veterans or like jobs where like you have to think on your feet, traders. I think that those kinds of backgrounds sometimes are really productive on a team. And maybe those people combined with like a good different skill set, like is a solid team. But those decision-making skills are important because where you then kind of go from there into, I don't have enough data. I'm going to allocate X amount of time to fact finding or whatever it is I need. I'm not going to linger. I'm going to tell the people what I'm looking for. And then I'm going to act on that and follow up. Either way, we use the same methodology on passing on a company. If there's anything concrete, that's how we operate. And I usually tell the companies I'm diligencing, this is what I'm going to do. And this is what I'm going to diligence. It's not a secret. And I end up working with the founders on that. It doesn't always lead to an investment, but it also strengthens your ability to then figure out how you work with the founder, how they decide, how they're communicating. So it goes both ways. We also practice what we preach on this front.
Yeah. It sounds like there's a bias to speed for you and that you want to see with founders, but also a bias to figuring out what does clarity look like? How can you get to clarity? Can you get to clarity quickly enough? I'm gonna borrow that. I'm gonna steal that framework. How do you think about sourcing investors for you or for founders specifically? Like top of funnel strategies, cold outbound, warm intros, this kind of stuff. What's some of the advice that you would give having learned that?
Those days where you like show up at a VC firm and like know all about it is kind of like hard to do, but also not. A lot of us are very active in public. And so it's actually 1 second work to figure out like what we do and how we operate. But at the same time, there's so many lists out there. So I actually think that's not that hard. I would say like someone needs to just build a software that puts every VC firm on one side and how you're connected to them on the other side in the middle. So just like you can just like click on those, get me intro. It's really not that hard. And maybe one day I'll build it.
That could be a venture-backed company.
No, it can't, but I will build it and donate it to open source at some point when I have enough resources.
When you're talking to a founder that you've invested in, if they want to reach an investor, do you think like a tight cold email, if they've done their research, is good? They should like work to get that warm intro.
I want to say warm intro, but we also do cold deals. So I guess truly knowing who you're reaching out to. What's sufficient for me, so-and-so told me to reach out. It's okay. Because if you're just saying, I'm going to wait for these 100 intros, like how many people are not going to do 100 intros for you? So you're limiting the amount of people you really get access to by that point. I work faster than most people. I work faster than AI bots. So I'm impatient. And if I want an intro, I will ask 10 people. Or I will if it's acceptable in the industry, I will email them and say, so-and-so told me. So in VC, that's very acceptable. 20% of our deals are cold, inbounds from founders. I think the hustle shows through. So there are a ton of VCs available on Twitter and LinkedIn. And I would say you can easily engage with them meaningfully. But at the same time, if that's not your cup of tea, then you're stuck with the universe of people then you get interest to.
You I think are more accessible than most. Like you are very upfront in your Twitter, in your LinkedIn. You even have like, this is the check size we're writing. These are the kinds of rounds. This is the kind of company. It's probably bringing you a lot of inbound deal flow. How do you manage the volume and find what's interesting to you and separate it efficiently?
I don't know. We've just developed an algorithm and we actually have software on the back end that kind of helps us through that. But it's like, the thing is, we're not a generalist fund. If anybody's raised any money before, they're out. If anybody's not AI data enterprise, they're out. That's like, the thing is, we see 1,000 deals a week and we only maybe take 5 meetings and do new companies a week. Of those 5, I go in with the intention of wanting to invest, but I don't always invest in all of them. So we do about 9 deals a year.
That's a very, very low conversion rate for those founders.
Yeah.
When you're looking at those 1,000, what makes it into the 5 for the week's meetings?
What makes it to the 5? Again, it's just a fit. We are very clear about what we're looking for. Array company, raising the right amount, right background, technical, so it's just an obvious deal for us.
high likelihood that it's going to be a fit based on your parameters.
Yeah. And then if it's in a space we know or not know, we have to have a thesis as well. So that's when we take the meeting. If we're like, I think this is the right thesis from the deck and everything else we're seeing.
Yeah. We've got two small sections left on the show here. First is about investing, but more from a personal lens. And then the second is just some wrap-up questions. On this first investing question, I'm putting out the disclaimer always that this is not legal, tax, or financial advice.
The lawyer speaks.
Have to do it. For a founder who's had a small early exit, or a GP who's had some success, let's say they're between 1 to 10 million of an outcome for them personally, what would you say is the right way for them to allocate that capital to invest across whatever opportunities are available to them?
That is such a fascinating question.
Assume that they're planning to continue, working, building, whatever it is for another, 10, 20 years.
I would say 30-year bonds.
Really?
I'm just kidding. Complete joke. I've learned from some of the best people who made their wealth, like, in the .com or before, like Sun Microsystems and things like that. And some things that they said really made sense to me, which was, I've built tech, I know how to invest in tech. Tech can mean a lot of things to a lot of people, but it could mean like creating like recycling facility for lithium mining. It could be anything. It's tech. So there is no world without tech. Now, if you can have differentiated access to areas well, I would say definitely invest in that. So like, in my opinion, allocate a small portion. So I went to Booth. You're asking a very tough question to someone whose whole business school foundation and Nobel laureates have all created like the famous pharma models and all around how to make money. And then I come from, and so everything I'm giving is like a contradiction of both of. So Booth is different than Silicon Valley. So Silicon Valley mindset is, don't diversify as much, go into as much as, like, put all your eggs in one basket to some level. That's what we all do, right? Like when we're starting companies, that's our wealth. And that's the success. And I think that actually is like, if I make 10 million, I would say like put in at least 2 in towards my next one, right? Like that's how I think about it. But if I make 10, I would say like worst is you're going to pay like a big portion of taxes. So that, unfortunately, I would look for an exchange, a small business, look for your friend's company within 60 days if it's not a qualified stock. Again, I'm just giving you random stuff.
Yeah. Avoid the QSBS or maintain the QSBS as well as you can.
I think maintaining QSBS is the highest thing you can do to change your tax bracket. But then if you didn't, right, like then I would say like, I would think about if you are going to start angel investing, I would say like go in with like a pool and then do 30. So let's say like you can say if I made 10 million, I'm going to put 500K in about 30 companies. Oh, and over 3 years, right? Not first year. A lot of people who made money in 2021 and then put money in 2021 in all these companies are not going to make money in a lot of them. So I think that's one. Second, I would think about like a way to then get access to asset classes that other people don't get access to. That a lot of your wealth managers can provide you, like pre-IPO things, funds, timber projects, I don't know, vetted things that you feel like experimentation you can do it. And then I would say, don't be afraid of like putting more money in things, whatever that is.
Yeah, your expertise, double down on your expertise. Great. Well, thank you for that. Not advice. Let's go to the last section here. This is just a few questions, 1 fun one and 3 serious ones. First, what food would you eat if you could only have one food for the rest of your life?
Pani puri.
That's going to be a very short duration, I think, before that goes poorly. But go out in a blaze of glory. I like it. Respect. What's the hardest lesson you've had to learn in your career?
I don't know, transparency and what it means to different people. Yeah, I think that's a lesson from 2024. And I operate from a place of transparency, but the feedback always is, well, yeah, but you're not transparent about 100% of the things. And it's like, yeah, how can I be? So there's a catch with everything and how people perceive your transparency.
I think there's a really interesting thread in there in terms of like people want transparency, but they don't want full transparency. It can be overwhelming, right? It's almost like, I'm trying to remember who I heard this from, but I think it was a couples therapist that was like, you want transparency and honesty between a couple, but you don't want full transparency because then no one should be subjected to the full unvarnished thoughts from their partner. But we'll move on to the next question. What's been the best moment of your business life so far?
I think the word you use, kingmaker, is a meaningful one. When my founders call and say they're buying that beachfront property that is like, $5 million or like whatever it is, it's amazing to see that you're part of this, and I love it. I think it's like whatever kingmaker needs to be. Like most of us don't need to buy that beachfront property. I'm just saying that it's that the kind of founders I back are immigrants. They have no idea, like how to like stay in the country oftentimes. Going from there to then having like their bank account changed after like years of struggle, but then not like really changing themselves is like, those moments are amazing.
Last question for you. Who's helped you the most in your career?
So many people, frankly. Like I would say a lot of fund managers who started their funds in like 90s, and such. I've been fortunate to have those folks around me, and I call them in moments of crisis. I mean, like there's a lot of us who are just doing this as a new thing. Even if I've been doing it for 10 years, it's 5 less cycles than what they've seen. Some of these people are on my speed dial. They've seen it before in different shapes and form, and they have a very like nice way of giving me perspective on like, this happens, this is what we did, here's what that manager did that at that time, here's how they survived, here's how they won, here's how they lost. And that repeat of history or not, it's a great way to have those people in my life.
Awesome. Well, we'll leave it there. Shruti, thank you so much for making the time and for sharing with us.
Thank you for such amazing questions.
Thanks again for tuning in to this episode of Money Moves. If you learned something new or just loved this episode, click below to subscribe. See you next week.